Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on corporate goings on. And today we're looking at a filing that is essentially a company saying, we're done with that particular deal. So, what is the big news today? NextNRG Incorporated, or NXXT as you might see them traded, has just filed a report saying they've officially put the brakes on a significant funding agreement. Is this a sign of trouble or just a smart business move? Let's dive in before we get too deep. If you are all about understanding what these filings really mean without the corporate jargon, make sure you are subscribed. And hey, we've got a growing community over on Discord where we break down these kinds of things further. The link is in the description below, so join us there. Alright, we're looking at a Form 8K filing from NextNRG Incorporated. This is essentially a report for big events that shareholders need to know about right away. Think of it as a company's urgent announcement to the public and the stock market. The company here is NextNRG Incorporated. They are incorporated in Delaware, which is a common place for companies to set up their legal home. Now, a key piece of information often buried in these forms is what the company's stock is actually listed on. For NextNRG, their common stock, which is the basic type of ownership people buy, trades on the Nasdaq Capital Market under the ticker symbol NXXT. This tells us they are a publicly traded company, and this filing is for everyone who owns or might consider owning a piece of them. The main event in this filing is something called a termination of a material definitive agreement. In plain English, this means they've ended a really important contract. This agreement they're ending is with several agents, basically investment banks, that were helping them sell their stock. It was an at-the-market or ATM sales agreement. So what does that mean? An ATM usually lets a company sell shares of its stock directly into the market over time to raise money, kind of like a continuous offering up to a certain total amount. Initially, this deal was set up so NextNRG could raise as much as $75 million by selling their stock. This is a pretty substantial amount and would typically be used for things like expanding the business, paying off debt, or funding new projects. This agreement was first put in place back in July of 2025. Later, in November of 2025, they amended this agreement, which means they changed some of the terms. The biggest change was reducing the total amount of money they could raise through this ATM from $75 million down to $60 million. This could suggest a few things. Maybe they didn't need as much cash as they originally thought, or perhaps market conditions made them revise their fundraising goals. But the really crucial part for today's filing is that as of the 17th of January 2026, NextNRG has officially terminated this entire ATM sales agreement. This means they are no longer offering or selling their stock through these specific agents under this particular deal. This termination occurred after they provided the agents with formal notice. So, the option to raise up to $60 million through this channel is now closed. Now, companies have to follow specific rules about how they release important information. Regulation FD, or full disclosure, is all about making sure that everyone gets important news at the same time. So, to comply with that, on the 23rd of January 2026, NextNRG put out a press release. This press release announced the termination of that ATM agreement. They've attached that press release as an exhibit to this 8K filing, meaning it is part of the official record. They are also making sure to state that any information on their website is not considered part of this report, which is a standard legal disclaimer to keep things clean. The company is also adding a note that this information, while public, isn't technically considered filed for certain legal purposes, meaning it doesn't automatically put them in line for certain penalties, like being sued under Section 18 of the Exchange Act if it turns out to be inaccurate. This is common language in these types of disclosures to manage legal risk. And finally, as most filings do, they list out the exhibits. The key one here, besides the cover page interactive data file, which is more for computer processing, is Exhibit 99.1, which is that press release from the 23rd of January 2026. Announcing this termination, there are no other major financial statements or exhibits being filed with this particular report. Which makes sense since this is about ending an agreement, not reporting quarterly earnings. Now, let's put on our investor hats and think about what this actually means. Ending a funding agreement, especially one that could provide up to $60 million, isn't usually done without a reason. One possibility is that NextNRG has secured funding elsewhere, perhaps through a debt offering, a private placement, or even strong operational cash flow, making the ATM unnecessary. If they have a new, more favorable financing route, terminating this one makes sense. However, if they were relying on this ATM to fund their operations or growth and they don't have a clear replacement, this could signal a potential cash crunch or a scaling back of ambitions. Another angle is that the terms of the ATM. Even after the amendment became unfavorable, perhaps the stock price was too low to make selling shares attractive, or the agent's fees were too high. In a volatile market, companies often have the option to terminate these. And if they feel it is no longer in their best interest, they will. We also need to consider the company's overall strategy. If NextNRG is shifting focus away from rapid expansion and towards profitability or consolidation, they might not need to continuously raise capital through stock sales. Terminating the ATM could be a signal of this strategic pivot. Without seeing their latest financial statements here, it is hard to say definitively if this is a positive or negative development. However, if a company terminates a substantial fundraising agreement, it is always worth investigating why. We'd want to look at their cash position, their burn rate, how quickly they spend money, and their revenue growth. If sales are strong and they have plenty of cash, this termination is likely a good sign indicating they've found better ways to finance themselves or no longer need the funds. If their financials suggest they are burning through cash quickly and revenue is stagnant, then this termination raises a red flag about future funding. Looking at the bigger picture, NextNRG is in a sector that can be highly dynamic. If they are in renewable energy, as the name might suggest, they are likely facing both immense opportunities and significant competition. Terms of funding agreements can change, and companies must remain agile. This termination could just be a proactive move to adapt to evolving market conditions or internal strategic adjustments. It is a sign that management is actively managing their capital structure, which is generally positive, but the absence of a large potential funding source warrants monitoring. So, to sum up, NextNRG has officially ended its agreement to sell up to $60 million worth of stock. Whether this is a strategic step forward or a sign of potential financial tightening will depend on what happens next and what other financing options they pursue. We will definitely be keeping an eye on their future filings to see how this plays out. What is your take on this termination? Do you think it is a smart move by NextNRG or a cause for concern? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate analyses. And again, don't forget to join our Discord community. Thanks for watching, and we'll see you in the next video.